Coming up on the Wheelhouse Retirement Show, we take a look at what you should consider when it comes to tax planning during your retirement. And you'll learn the difference between filing your taxes jointly versus someone who has to file on their own due to a loss of a loved one. Plus, Rishi will explain how tax loss harvesting can be an important tool during retirement. And are you looking at ways to retire from your company that you've worked for 20 plus years? We take a look at a potential tax-saving opportunity that could help your future. The Wheelhouse Retirement Show starts right now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
Welcome into the Wheelhouse Retirement Show. I'm Amy Sharp. Joining me today is Rishi Ghosh and Anthony Stryker with Wheelhouse Advisory Group. It's always great to be with you guys. How are you?
We are doing great. Excited to be back.
I'm very excited to have you. We've got a great show for everyone today. We've talked about tax planning quite a bit on past shows, and today we're going to kind of get into real net worth versus paper net worth. Talk about the differences. What's involved in that?
You know, this real net worth versus paper net worth is something we've been talking about for many years. And actually, it started after a conversation with my father. And, you know, I've talked about my dad quite a bit on the show because a lot of how Wheelhouse's philosophy has been grown and the values have been brought onto the firm over the years has been based on watching my parents retire and really envisioning their retirement over and over again for our prospective clients as well as our current clients. So my dad, as a lot of people know, is an extremely savvy money manager, extremely analytical, extremely mathematical, and very good at overall retirement planning. But one of the things that he brought up to me about 6-7 years ago is, you know, he said, Rishi, your mom and I fell for kind of a myth, a problem. And I said, what do you mean? And he said, you know, we accrued the majority of our nest egg through our 401ks and IRAs because I was under some belief that I was going to pay less in taxes once I got to retirement compared to my working years. And I'm finding out very quickly in these first few years of retirement that I'm not paying a lower tax rate. I'm actually paying the same amount, if not some years a little bit higher. So he said, I really built something called a paper net worth. And that was the value that he was seeing within his IRAs, within my mom's 401ks, compared to the real net worth, which was the value after tax that he would get and actually be able to put in his pocket. So one of the concepts that we try to drive with all of our prospective clients as well as our clients is, do you know what your paper net worth is versus your real net worth? And real net worth is obviously the key here because that's the money you're going to be able to spend, vacation with the family, and more importantly, take care of your month-to-month needs and your one-off expenses.
All right, I love to hear the stories about your dad. Every show, it's always good to weave that bit because obviously that's where this all came from.
It was all built based on watching them retire over and over again.
Absolutely. All right, so tax planning, where do we get started? What are the things that we need to consider? There's so much that goes into it.
So it's really important to start for a client or a retiree to understand how my money is taxed, all of the money I've saved, all the money I have in my bank, what our tax classifications are. And so there are really three tax buckets, as we like to call them. You know, we always like to talk about buckets on the show, but these three different worlds of taxes are three different buckets. The first one on the left side of our chart here is the pre-tax. That's monies that you add to from maybe a retirement plan. You get a deduction that year that you add that money in, and that money grows tax-free or tax-deferred, as we say, and you don't actually pay taxes on that money until you take it out when you are retired. So that's all money that, like Rishi said, a lot of our retirees, a lot of our clients and viewers have paid into that bucket a lot, and they don't really know what taxes they will pay whenever they do take that money out. Now in the middle we have our after-tax bucket. So this is usually money that's in a bank account. It's money that's already been taxed, came from your paycheck or came from another source, and that's taxed a little bit differently. You have the growth on that and the interest on that comes, or dividends. That's taxed as it comes each year from the investments or from the different types of vehicles that you have in there. And then they're also taxed a little bit differently. They're not taxed at ordinary income rates. There's a completely different capital gains rate that gains on this after-tax money that you have to pay. And then our favorite is on the right side here, our tax-free bucket, or our golden nugget bucket, as we call it. And that's money that's already been taxed. So it's after-tax money that goes into those accounts. The growth, the interest, the distributions from that account are all tax-free. So if I see $100,000 in a tax-free account, that is a true $100,000. So if we go down the line quickly with our pre-tax accounts, we've got IRAs, 401ks, SEP IRAs, simple IRAs, a lot of work plans. Most work plans, whether it be governmental or nonprofits, they have a lot of pre-tax plans. After-tax accounts, things like individual accounts, trust accounts, joint accounts, just overall non-qualified accounts. And then our tax-free, our favorite accounts are those Roth IRAs, and some work plans have even Roth 401ks that you can add to, or Roth 403bs. So what we really try to help our clients with is, how do I take my pre-tax money and get it over to our tax-free bucket? And that's where our Roth conversions come in through our proactive tax planning, where you're deciding to prepay some of those taxes in the pre-tax bucket and make sure that money from that point forward grows tax-free, so you have a real net worth to look at in retirement.
Okay, that's a lot of great information, a lot that goes into it, of course. And there's these 3 tax classifications. You're going to take us a little deeper into that.
Right. So as Anthony mentioned, one of the biggest strategic planning processes that we use here at Wheelhouse is helping our clients get from pre-tax to the tax-free account, because that's moving from a paper net worth to a real net worth. And we generally tend to see that people have really 3 objections when it comes to that type of planning process. Even though they all want to get to tax-free, there's obviously some questions and concerns that go along with that. So number 1 objection that I generally see is, no one's ever showed me a path on how to do it. No one's ever given me a strategy. I know I want to do it, I know I have to do it, but no one's ever shown me how to do it. So that's obviously something we help our prospective clients as well as our clients year over year take care of. Number 2, people are very scared to pay taxes, because who wants to pay taxes when you don't need to? And the 3rd objection we generally hear is that if I quote unquote prepay some of those tax dollars early, I'm losing the growth power on that money. And actually, I brought an example down here today because I'm kind of a math person myself here, on why I personally believe that's not really true, that if you prepay some of your taxes, that you're losing value long run. Now, the example really here is, let's just say we take a simple $100,000 IRA. And Anthony and my wealth managers and our team here say, you know, guys, family, let's go ahead and prepay some of these taxes, meaning let's move it to a Roth IRA, to an account that can grow tax-free. Well, in order to move that $100,000, you have to pay taxes. So just for today's example, let's say between federal and state, they pay 24% federal and state combined. So that means now you have $76,000 in the tax-free Roth IRA. So $100,000 in the pre-tax IRA, $76,000. So on paper, obviously the IRA is bigger. Let's just say both accounts are invested the exact same way, and we'll just take typical market rates of return and invest it in growth portfolios, and over the next 20 years, they average a 7% rate of return, which means 10 years later, the $100,000 is now $200,000. 10 years later, the tax-free $76,000 is now $152,000. 10 years after that, the $200,000 now becomes $400,000, and the tax-free $152,000 has now doubled to $304,000. So now you're looking at $400,000 in the pre-tax, $304,000 in the tax-free Roth IRA. But what's the difference? The $400,000 is still a paper net worth. So we said the 24% federal tax bracket right now, and we know in 2026, the equivalent 24% bracket's going to 28%. So let's just hypothetically say now the kids inherit the $400,000, and somehow, even though they'll probably be in a much higher tax bracket at this point, they're able to get all $400,000 out at a 28% federal tax rate, which is probably low, but let's just say the 28% tax bracket. After tax, the family now has $288,000 from their pre-tax, after tax into their pocket, whereas the tax-free Roth IRA, which is at $304,000, all $304,000 moves on tax-free. And the biggest difference in this 20-year example, the Roth IRA is growing 100% tax-free. It does not matter what happens with tax law changes during that time frame. The $100,000 pre-tax account, which went to $400,000 on paper, $288,000 after tax, you have to worry about what Uncle Sam does or the IRS does that entire 20 years.
We're off to a great start. Thank you so much. And are you wondering what filing tax status you should choose this year? Whether you're married or you've lost a loved one. Coming up, we'll explain your options. Plus, Rishi explains how tax loss harvesting can be an important tool to reduce tax liabilities. That's next in this week's Tip of the Week. And later, how tax strategies today can impact generations to come. The Wheelhouse Retirement Show continues next.
You've worked hard to build up your retirement savings, but do you know how much you're paying in fees in your investment accounts? Hidden fees can eat away at your hard-earned dollars, and most investors don't know what they're actually paying in fees. I'm Anthony Stryker, and our team at Wheelhouse Advisory Group can give you a fee analysis so you know exactly where your money is going. Call us to learn how to keep extra costs from eating away at your retirement. Get your complimentary fee analysis today.
Welcome back to the Wheelhouse Retirement Show. We're back with Rishi and Anthony, and we're taking a look at the tax status of married filing jointly versus someone who has to file as single after losing a loved one. And this is a difficult topic to navigate for someone because they all of a sudden feel a lot probably out of control.
Right. It all comes back to our mission statement, Amy, which, comes back to my parents, which is control the controllable. We can't control where tax rates go, but we can control our tax-efficient portfolio. We can't control where the stock market goes, but we can control the amount of risk we take. And we really can't control our health and longevity, but we can always make sure we have a rock-solid estate plan set up to take care of generations to come.
Are there a lot of assumptions out there when someone loses a loved one that they all of a sudden move to a different tax bracket?
I remember actually an example where a prospective client came into our office and they were about 3 years into retirement, and actually the husband was a phenomenal self-manager, extremely mathematical, extremely analytical, and very proactive with a lot of their planning. And actually what ended up happening, unfortunately, was he passed away unexpectedly just 3 years into retirement, and his spouse came to us because she was a little bit lost. She didn't quite understand the plan, but one of the misconceptions that she thought and they thought was they didn't do any proactive tax planning, and they thought when one person passed away, they'd actually end up in a lower tax bracket, which actually Anthony's brought an example here why that's really not the case.
I wanted to bring this example, and we've got a hypothetical retired family. They're both 75, and they have IRA assets of about $500,000. So let's take a look at their income, and this is really a mock tax return, and this is something we do for all of our clients to look at what will your taxes look like each year and what will happen if maybe you pass. So Bob's got his Social Security coming in at $30,000. He might have worked for one of our larger companies in the area in St. Louis, might have been an engineer, and he's getting a pension of $24,000 that if something happens to him, 100% of that will go over to Mary. And then Mary's got her Social Security of $15,000, but because they have that $500,000 IRA and they're over age 72, they have to take a required minimum distribution on that of about $20,000. So that puts their adjusted gross income at $89,000. We take out a standard deduction, and that puts their taxable income at $60,500. So all of that income lands them in the 12% tax bracket. So now something happens to Bob, and Bob's not here. And we want things to change as little as possible for Mary, and we want to make sure she understands what's going to happen with her financial situation and how that changes her tax situation. So the lower Social Security is gone now. You keep the higher one. So Mary's still got this $30,000 Social Security coming in. She's still got that pension from that firm of $24,000, and her RMD is still about $20,000. So that puts her adjusted gross income this year on a single filer bracket at $74,000. There's lesser of a standard deduction you can take as a single filer. So her taxable income is a little bit less at $59,800. However, if we look at the difference between the married filing jointly tax tables to the single filer, which Mary is now on, she was once in the 12% bracket while Bob was here, but now she's in the 22% bracket. That's over an 80% increase in overall taxes, in tax percentages, and marginal tax rate there. So while people think they might have less income, they might be in a lower tax bracket when one spouse passes, this is a situation where that might not be the case.
Yeah, and you brought it up. So many people don't want to change their lifestyle. You certainly don't want to change it as you get into retirement. Then you lose a spouse. You still are wanting to do the same types of things. You have to think about that as well.
We ask our clients over and over to dig deep on, the B word, we call it the budget number, and what is really their need on a month-to-month basis. And I believe when people come into our office, as we call them, some myths come about in the pre-retirement stage that if somebody passes away, you're going to need significantly less income. I will tell you, Anthony and I have studied, hundreds of families' budget templates that they bring into our office. And generally speaking, about 80% of a month-to-month expenditure are needed expenses, not fun expenses, which means even if somebody were to pass away, you're still going to need that same amount of income in order to pay your bills and maintain your lifestyle. So the thought process of, when Bob and Mary are around, we need $8,000 a month, but Bob passed away, Mary only needs $4,000 a month. While some of that extra money may go down, those needed expenses will always be there. And as Anthony's example really showed that, you could find yourself potentially in a much higher tax rate, or in this case, 84% tax increase from the 12% to the 22% bracket in a bad situation, in an uncontrollable situation, which is the death of a spouse.
Do to kind of control this situation a little bit. In the first segment, we talked about those Roth conversions. Does it make sense to move money from pre-tax, pay some taxes now, and make a little bit more of the portfolio tax-free? In this situation, that might be a good idea, because while Bob was alive, they were in the 12% bracket, but when Bob's not here, Mary finds herself in the 22% bracket. Obviously, we'd want to pay more taxes in that lower tax bracket while Bob is here and we have a dual income.
That required minimum distribution is what we're trying to alleviate. Generally speaking, whenever the government forces you to do something, which is called your required minimum distribution, which at 72 years old, you're now forced to take a withdrawal on your IRA regardless if you need it or don't need it, by moving that to the tax-free Roth IRA in a proactive tax strategy, the Roth IRA no longer has that required minimum distribution. Hence, when you're a married jointly tax return, proactively paying tax at a lower tax rate gives you a better opportunity long run to have a successful retirement.
Important insights as always. Thank you so much, gentlemen. Coming up after the break, Rishi and Anthony will walk us through tax loss harvesting. That's next in our planning tip of the week.
Did you know taxes could be your biggest expense in retirement? No one can avoid taxes completely, but with the right strategies in place, you could potentially reduce your tax bill in retirement. Having a plan to protect your retirement savings from higher taxes could mean more money in your pocket and less to the IRS. At Wheelhouse Advisory Group, helping people like you minimize your taxes in retirement is something we are truly passionate about. Call us today to learn ways to possibly lower your taxes in the future.
Hi, I'm Rishi Ghosh with the planning tip of the week. We want to take some time to understand tax loss harvesting. Deploying a well-diversified portfolio means that while some stocks perform well, there will be other stocks that decline in value based on certain market conditions. It is important to plan ahead with strategies that could provide meaningful tax savings. Tax loss harvesting is the timely selling of investments at a loss to offset the amount of capital gains tax due to the sale of other investments at a gain. Capital gains are the profits you realize when you sell an investment for more than you paid for it, and capital losses are the losses you realize when you sell an investment for less than you paid for it. For many investors, tax loss harvesting can be an important tool for reducing their overall tax liabilities. Tax loss harvesting generally works like this. You sell an investment that has underperformed and declined in value, then you use that investment loss to reduce your taxable capital gains and potentially offset up to $3,000 of your ordinary income. Finally, you reinvest the money from the sale into a different security that meets your investment needs and overall asset allocation strategy. Let's go over an example to better understand tax loss harvesting. In reviewing your investment portfolio, you see that Fund A has a gain of $30,000 and Fund B has a loss of $15,000. Tax loss harvesting is a method to consider offsetting these gains. If you sell Fund A that has gains of $30,000 and then you use the losses of Fund B of $15,000, your $15,000 loss would offset the $30,000 gain. By doing this efficiently, your total taxable capital gains would be lowered to $15,000. Oftentimes, we see that investors only sell the minimum amount needed in their portfolio in order to help them reach their goals. In this example, if the investor were to sell only Fund A that has a $30,000 gain, the full $30,000 would be considered a capital gain and would be taxable. By utilizing tax loss harvesting strategies in this situation, your total capital gains bill for the calendar year would be reduced to a tax bill of $2,250 versus a tax bill of $4,500, thus saving the family potentially $2,250. In addition to potentially lowering your capital gains bill, if you ever find your portfolio in a position where the loss is larger than the gain, you can use the remaining loss to offset up to $3,000 of your ordinary taxable income, which means if you have $50,000 in taxable income, you can factor in your capital loss to reduce your capital income to $47,000. Amounts over $3,000 can be carried forward to future tax years to offset income later. As with any tax-related topic, there are rules and limitations, and each individual situation would need to be reviewed with your advisor. The general principle behind tax loss harvesting is pretty straightforward, but you need to consider these rules. Tax loss harvesting is not intended for retirement accounts such as 401k plans or IRAs because you cannot deduct the losses generated in a qualified tax-deferred account. There are other restrictions on using specific types of losses to offset certain gains. A long-term loss would first be applied to a long-term gain, and a short-term loss would be applied to a short-term gain. If there are excess losses in one category, these can then be applied to the gains of either type. Beware of the wash-sale rule, stating a loss cannot be realized for tax purposes if a substantially identical position was bought within 30 days before or after the sale. As a practical example, an investor could sell an actively managed equity fund and redeploy the sales proceeds into an equity index fund. In doing so, the investor would recognize a tax loss while also keeping similar but not identical portfolio exposure. Working with your trusted advisor to harvest losses proactively can save you money over the long run. That's the planning tip of the week this week. I'm Rishi Ghosh, and we'll be back. You may be surprised to learn that your taxes could go up in retirement. That's right, you could be paying even more taxes in retirement. With the threat of possible tax hikes looming, your retirement lifestyle could be in jeopardy unless you take action. Now's the time to take advantage of proactive tax planning strategies to keep even more of your hard-earned dollars and give less to Uncle Sam. Find out by scheduling your complimentary 30-minute strategic planning call now. You've worked too hard to overpay taxes in retirement. Schedule your complimentary call today.
Welcome back into the Wheelhouse Retirement Show. We're back with Rishi Ghosh and Anthony Stryker. We recently discussed 2 strategies that can help retirees with their taxes during retirement. And that's not all. We are just starting on this conversation. There's more to this, isn't there?
That's correct. We've always got more. And the information we've talked about today of knowing your tax classifications, knowing your paper net worth versus your real net worth, and the timeline of, should I start doing tax planning when I have more income or less income? Am I on a joint filer or a single filer when I lose a spouse? Those are very important topics. We also wanted to bring another topic here that might apply to someone who has worked at a company for a very long time, a publicly traded company, and has grown a lot of company stock in their 401k through that company retirement plan. This is called net unrealized appreciation, or NUA.
All right, that's a big one. So we're going to go a little deeper into that because this can be difficult. Just like any topic that retirees have to kind of be faced with, there's a little bit more to it. It's more complicated. So talk about exactly what an NUA is and who can benefit.
So as Anthony mentioned, NUA, which is really called net unrealized appreciation, is nothing besides a tax strategy. Now, it is a complicated tax strategy, but if executed properly, could potentially save you quite a bit of money when it comes to your taxes. So it really works well for somebody who works at a publicly traded company and has acquired that publicly traded company's stock within their 401k. Let's just say that stock over a 20, 30-year career has appreciated, maybe doubled, if not tripled or quadrupled in some situations. What the net unrealized appreciation strategy allows you to do is pull that company stock directly out in kind, meaning as stock, out of that 401k directly into an after-tax brokerage account or trust account. And what you would actually do is pay taxes on the full cost basis, meaning the amount that you paid for the stock. But all of the gains, instead of being taxed at ordinary income tax rates, all the gains, meaning the doubled if not tripled value, would be taxed at long-term capital gains rates. So it's a little confusing here, but it works very well if you utilize a strategy properly.
And there seem to be a lot of potential benefits from this NUA strategy that people can use.
There certainly can be benefits in the amount of tax savings that you can have. So I did want to bring an example of how this might work for someone. So we're talking about someone who has started and they've worked at a company maybe 30 or 40 years. It's been their whole career. And in this situation, they've got a stock holding of their company stock in their 401k of total $600,000. Now, because they've been there so long, they've only put $200,000 into that stock. So all the rest is growth. The $400,000 plus the $200,000 is the total $600,000 stock holding they have. So they have one option. They can roll all of that money into an IRA through a 401k rollover, or they can use this NUA strategy. So if they were going to utilize this NUA strategy, what they would do is take that cost basis, take all the stock, and move it into an individual account, that middle tax classification, the after-tax account. Now, with that strategy, this year that they do that strategy, they would pay income taxes on the cost basis of the stock. So that's $200,000 that they're adding to their income this year, which sounds like a lot, but the real savings that there could be is instead of the growth of that $400,000, instead of paying income taxes on that through the rest of their retirement, if they sell that stock, they will only pay capital gains taxes on that instead of those higher income rates. So in this situation, $200,000 is taxed today, $400,000 is not taxed yet today, but they'll pay about $48,000 on the cost basis this year when they complete this strategy. Then if they go ahead and sell that stock, assuming a 20% capital gains rate, they'll pay another $80,000 in taxes to total about $128,000 in taxes that they've paid on moving this stock out of the plan. Now, if we assumed that they went the other direction and they moved it from a 401k to an IRA and paid an average tax rate of 24% over the entire retirement, they might have paid about $144,000 in taxes. So there is some real math that needs to be done on, does this strategy make sense for me? Am I going to hold on to these shares and sell them all at once? But it is a strategy that can help people tax-wise if they've held on to company stock for a long time.
There's certainly a lot to think about. There's got to be rules and restrictions as well, I imagine.
We always advise to seek advice of a financial advisor or a tax consultant when it comes to this process. But yeah, there are rules and restrictions when it comes to this type of strategy. Number one, the employer stock must be distributed in kind. So as we mentioned earlier, if you're holding, let's just say in this example, Boeing stock, the Boeing stock would need to be moved out in kind out of the 401k directly. You have to take a lump sum distribution on that stock, meaning it has to come out as well as out of the plan. And then the distribution, the lump sum distribution, has to be made after a triggering event, whether it's death, disability, retirement, separation from the company, reaching 59 and a half. So there are some different rules and regulations. You got to make sure that you understand fully before executing this strategy. But if, as we mentioned, executed properly, it could have a lot of benefits.
Okay, sounds great. Thank you so much, gentlemen. And if you're ready to develop a comprehensive strategy for retirement, don't delay. Reach out by phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh and Anthony Stryker and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week, everyone. We'll see you next time.